been a while since I've had the opportunity to talk this way with you, but I feel like with what's going on in the world right now and what's been going on in the markets and a variety of different things, that it's probably time that I go through some of what MFG Wealth Management is thinking and how we're approaching it. And my purpose today is to encourage you, not to discourage you, because some of the information I'm going to be sharing sounds very, very negative. And so, as many of you know, I started in the money business back in 1990. And so I've lived through a few ups and downs, and nearly a year hasn't gone by in all of those years when there weren't several dark clouds or things to think about that some people would be getting concerned of, and perhaps even for some be a reason not to invest. But yet, as you look back at the market since 1990 to today, even through all of those dark clouds and ups and downs, there have been lots of money to be made during that time frame. And I'm confident that the years ahead will probably be the same way. But in all of my years of working in the financial industry, I must say that it seems that the dark clouds this past year and right now are looming larger and more than I actually can remember. And so I'm not 100% certain that is true, but it sure seems that way right now to me. And so I thought what I would do is utilize this opportunity to just highlight on a high level some of what I see, some of those clouds that I'm talking about, and just mention them and some of why perhaps they exist. And then I'm going to wrap this up letting you know how and why we have allocated our portfolio in such a way that we have right now, and what we see maybe down the road here a bit. So the first dark cloud, I guess, and none of this will be new to you if you watch the news at all, but the first one I just want to mention, which I don't think gets enough airtime, is the U.S. national debt. Our country right now is in debt up to $32 trillion, and with interest rates rising, that debt that we have is getting more intense to service, as you can imagine. And so, for whatever reason, the people running this country don't seem to think that's a big deal, but I think it's a huge deal. And you know, if we ran our households anything close to the way that they spend money relative to what they don't have, we would all be in serious trouble. If you ran a business that way, your business wouldn't be around very long. And so at the end of the day, the idea of the government continuing to spend money that they don't have and borrowing it, I feel is putting some pressure on our nation. So that's a dark cloud that I would love to see our Congress address and start getting a grip on. Geopolitical issues all over the globe right now, as you guys are aware. And so, you know, we often hear about the Ukraine situation, but there's things going on with China right now that are quite serious, in my opinion, as well. Inflation is, you know, all of us know what that feels like. If we've gone to the grocery store at all, we know what inflation feels like, and inflation has gotten a bit out of control. It is beginning to trickle down maybe in some categories right now, but the inflation isn't an accident, and it's just amazing to me to watch our country do the same mistakes over and over again. When you print $6 trillion of money and throw that into the economy, into the system, it's almost a sure thing that the outcome of that is going to be that you have too many dollars chasing too few goods. COVID certainly didn't help with that, relating to in relationship to supply chains, which made probably accelerated inflation a good bit. But at the end of the day, virtually impossible to print $6 trillion and not expect anything other than an inflationary outcome to that. And so the inflation that we're experiencing has then triggered something, right? And so we have the Fed, the Federal Reserve, and they have a dual mandate. One is to try to keep full employment, but the other is to try to keep inflation at a 2% level. And so their approach to getting inflation to coming down is to raise interest rates. And to my knowledge, I've never seen interest rates rise this quickly in such a small window of time. But the Fed fund rate has gone from 0 to 4.75 to 5 in less than a year. and virtually impossible to have that much tightening in the interest rate environment and not have some serious consequences to that. And so if you watch the news again at all, you all have heard of SVB Bank and Silicon Valley Bank, and we know what took place there. The government did come in and put a backstop there on the depositors, but at the end of the day, there's an underlying problem that I'm not sure that everyone fully understands. So some of you, I'm sure, do, but I thought that I would take just a minute to walk through the root of the problem in the banking system, and not just that, but also I would say we will see more of this in the next year, but in the commercial real estate industry, with people working from home so much more and not going back to the office, there's an awful lot of offices sitting vacant, but they have a bigger problem. And the problem is that the loans that they have on those spaces right now, as those mature, and many will between now and 2025, as those loans mature, they're going to have to refinance that debt at a much higher rate. And in many situations, I think we will see people not being able to afford to keep those commercial buildings, and they'll be handing the keys in and wanting to walk away. So that ultimately can stem into the banking industry as well. But what is going on is many banks chose to buy long duration bonds, and in most cases around 10-year bonds, sometimes longer than that, but 10-year treasury bonds. And what happens is, relative to the regulatory requirements they have in terms of how much capital they have to have on hand and in reserves to service their own obligations or liabilities, as well as to cover their depositors, the people like you and me that put money in those banks, the regulatory environment requires them to have a certain amount of money in reserves to back up those things. But then what happens is, when people start taking their money out of a bank, which we just saw, that regulatory requirement becomes more intense. But today, 2023, April 2023, right now, banks are not required to do what we call mark to market and on those bonds. And so here's what happens. So I want to give you the correlation between what happens when the Fed has to raise rates. So interest rates are going up. I don't know if you can see this, but I'm going to say that this bank bought this bond at par. So they bought it right here. But then the Fed starts raising rates. And as they raise rates, the direct relationship to those yields going up on those bonds is the price of that bond goes down. But because it's a 10-year bond, they're still showing it on their books as if it's worth par, even though it's actually not. When they have to recognize that drop in price is if for some reason the bank has to cash that bond in. So that's exactly what's going on, because now they need cash on hand relative to deposits coming out of their bank to stay solvent. And in many situations, and we're seeing it with a few other banks right now other than SVB, that's creating a real issue. And, you know, Lord willing, we won't see too much contagion going on here. But so that's a big issue in our country right now. And so I feel like the financial system has some problems that are as a result of rates going up so quickly. Some pressure's been put on them. But hopefully we'll get through that one. So let's see here. I know some of this sounds terrible, but there are opportunities that I believe are going to be presented when this washes through and this comes out to the other end. But what I would say right now is the price earnings ratio on the S&P 500 as a result of these things is still trading at about 18. And a lot of people, talking heads, are trying to suggest that perhaps we're going to have a soft landing, we're going to have a smooth runway, and going to get out of this without much pain at this stage in the game. In my 33 years in the business, I've not seen a bear market end with a price earnings ratio at 18 and the volatility index, which is called the VIX, right around 16 to 17. Rather, I've seen the volatility index way into the high 30s, if not higher, And I've seen the price earnings ratio at the end of a bear market be closer to 12 to 14. 16 would be in a healthy market, 16 is a good place to be from a valuation point of view on the S&P 500. Right now we're at 18. So at MFG Wealth Management, we are concerned with the clouds that I've been talking about. We're concerned that the market hasn't really had a washout. And so I wanted to let you know that we have positioned our portfolio at this stage in the game relative to what I've been talking to you about in what I would call a defensive mode. And so we don't just sell everything in the portfolio and go to cash, which would trigger all kinds of capital gains and other ridiculous things for you. What we do is we sell some of the small cap growth stocks, create some cash to use in hedging the long positions that we keep. And so many of the long positions that we've kept are dividend paying instruments. For example, AT&T, if you look at anywhere from 1 to 9% in our portfolio, you'll see dividends on many of the stocks that we've chosen to hang on to and ride through this with. But keep in mind, we're hedging on the other side against those long positions should they go down in value. But we'll be able to continue to draw the dividends. And we've also kept some growth stocks in the portfolio that we want to make sure we're in when this is over. And so our forecast is that things might get rougher before we find some green sprouts and some opportunities that we do believe things like this, times like this in history present. And so there is a lot to look forward to, but we need to get through a little bit of turmoil in our opinion. And so that's why our portfolio is set up with hedges in it right now, and wanted you to understand that. And we're doing the best we can to take care of your money and protect it. And we're willing to give up a little bit on the upside right now to make sure that we don't get hammered on the downside. So we care about you guys. We thank you for your business, and I hope this helps.